Hello everyone, thanks for tuning in. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online, while also sharing insightful videos, like this series, on all things business ownership and finance. Bookkeeping Basics is a 5-part mini-series designed to help small business owners and startups tackle the basics when it comes to managing their finances. I am releasing an episode a day over the next week, so make sure you are subscribed. In this mini-series, we are covering the whats, the whys, and the hows of small business bookkeeping. I'll be helping you to understand some of the financial lingo used when referencing accounting, why certain tasks need to be done, and ways you can stay on top of your to-do list. And I'll also be diving into how to complete these tasks and the simplest, most time-efficient ways to manage all your business's finances. My goal with this mini-series, and of course all the other content I put out on this channel, is to help small business owners flourish in their individual entrepreneurship journeys. As our world, our governments, and our societies are ever-changing, entrepreneurship is growing, and more people are taking control of their professional and financial futures. Hello everyone, welcome to the first episode in my Bookkeeping Basics mini-series. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online, while also sharing insightful videos on all things business ownership and finance. Here in episode 1, we are covering all the ins and outs when it comes to receipts. So why do business owners need to keep receipts? Well, this is a very loaded question. There are financial and legal consequences for not keeping accurate financial records. Receipts also aren't just the itemized slips you get at a shop checkout. The definition goes like this: but any record of the action of receiving something or the fact of its being received. According to the IRS, good records will help you monitor the progress of your business, prepare your financial statements, identify sources of income, keep track of deductible expenses, keep track of your basis in property, prepare your tax returns, and support items reported on your tax returns. Most business record keeping is related to the tax laws, so be careful to keep records appropriately. If not, you might face the following consequences. Pay extra in taxes. If you don't keep records of estimated tax payments or don't keep receipts for planned deductions, you won't be able to claim these items on a business tax return, and you will have to pay more tax than what is owed. Tax adjustments after audit. If you get audited and don't have paperwork to back up your claims, the IRS may decide that you need to pay more in taxes than you originally had to pay. There may also be costly penalties for the failure to file taxes appropriately. Audit failures. Failing an external or internal audit can lead to large fines or even the closure of your business. Improper financial management is the #1 reason new businesses fail. Criminal penalties for improper licensure. Without copies of licenses, a person can face jail time for operating without a proper business license. Inability to protect your business from theft. Without the right paperwork to justify claims, you may not be able to sue someone for copyright infringement or patent infringement. Employee lawsuits. If an employee claims you acted in an illegal manner, for example, a wrongful termination or a refusal to pay workers' compensation, you won't have much recourse if there is no paperwork to prove that you complied with the laws in your area. Always keep copies of any interactions your employees have with your staff that may affect you in a legal manner later on. Deals fall through. Losing or misplacing an important document can cause a major deal to fall through. Something as small as an old employee contract can hold up a transaction. greatly reducing your chance for success. In order to prevent these negative consequences of failing to keep accurate records, it's important to find a record storage system that works great for you and your business. It should also be a business requirement to have some kind of system in place in case you're audited. Receipts are a pain. It's a fact. It's easy to let them spin out of control. But no matter if you're a brand new sole proprietor or the proud proprietor of an S Corp, good record keeping means hanging on to your receipts. You should keep your receipts for as long as a taxing authority like the IRS or your state's Department of Revenue can audit you. Most audits can only go back 3 years from the date you file your tax return, but in some dire cases where fraud or severe tax underpayment is suspected, the IRS can audit you back to 6 years. Again, from the date you file your tax return. And that they do. But what the IRS doesn't explicitly mention is that if you don't keep the right records, you could end up in hot water. When it comes to keeping your receipts for record keeping, it's a good idea to adapt the better safe than sorry attitude and keep all that pertains to your business. It's also a good idea to consult with your accountant on this matter. But as a baseline, here are a few that you absolutely must keep. Inventory. Buying inventory to sell to your customers, or raw materials to craft into things that you sell. Then hang on to the documents that identify the payee, the amount, and proof of payment for the items. Get a receipt for those purchases if at all possible. If for some reason you can't get a receipt, keep the invoice and request the check image from your financial institution. Proof that the person you wrote it to cashed the check. Assets. Your assets are the property that you own and use in your business. Assets are generally things you keep and use from year to year, such as furniture, computers, vehicles, or machinery. If you've ever tried to handle assets on your taxes on your own, you know that you'll have to deal with complicated concepts like depreciation. Because of this, you should keep records of any kind where you spend money on your assets. For example, keep records when you service your bakery's oven or upgrade your company's computers. You'll also want to keep records should you sell one of your assets. Advertising. This could include web hosting, business cards, ads in magazines or online, billboards, etc. Car and truck expenses. If you're able to deduct car and truck expenses, you may need to keep your records for things like fuel and maintenance. Education expenses. Do you have to get continuing education in your business? Or did you take a class to learn something new? Keep your receipt or the invoice plus your bank records showing that you paid for the education. Entertainment. Take a client out to lunch? These expenses can be tax deductible, but be careful. Don't just keep the receipt. You should also keep records showing that your activities were directly business related. If you have questions about what meals and entertainment expenses are deductible, reference the IRS resources at irs.gov. Networking. Attend a conference or a trade show? Paying annual BNI or networking group fees? Just like the educational expenses, keep your receipt or the bill and your bank records as proof of purchase. Office supplies. Printer paper, staples, paper clips. All of these are tax deductible, so keep the receipts when you head to the office supply store. Professional services and contractors. Pay a lawyer to write up a contract, or maybe a graphic designer to design a new logo. Keep your invoice and your receipt when you pay the bill. Travel expenses. You may hop on a plane to visit a client or take a hotel room for a few nights to attend a conference. While the IRS has very specific instructions for deductible travel expenses, keep the receipts or bills for your travel expenses, should you be able to deduct all or part of your trip. Most of the time, a receipt is sufficient, but sometimes it's also worth it to keep the bill. Say, for example, you deduct a portion of your mortgage as a home office deduction. Since only a portion of your mortgage is deductible, you'll want to show how much really went to the cost associated with your home office. Other expenses. Most of your business receipts will likely fall into this bucket or category. The rule of thumb here is if you plan on writing it off on your taxes, you'd better have documentation that you really made that purchase. Keep the receipts or invoices if you spend money on anything. I can't stress enough how important it is to keep your receipts. Act as if you are going to court with the IRS and you have to plead your case. A case of he said, she said is never viable, so make sure you have documentation of all sorts. Being a business owner is like going into battle every single day. You are fighting your competition, auditors, legal regulations, and every day you come out victorious is a day to celebrate. Do I have to keep the actual paper receipt? 6 years worth of business receipts is a lot of paper. But fortunately, nothing says you have to keep the receipt in its original paper form. You can file them away or digitize them. It's up to you. QuickBooks Online has a free mobile app that allows you to snap a photo of the receipt. The app connects directly to your cloud-based QBO account, and from there you can match the receipt to the appropriate transaction within your banking tab. You can also scan your receipts with a receipt or document scanner and upload batches to your QBO account through the Receipt Center. If you want to know how to do this in detail, visit the receipt video under my bookkeeping tutorials. I'll also have it linked in the description box below. You can also, of course, keep hard copies in a filing cabinet. However, if this is the route you wish to store your receipts, I highly recommend making a copy of the receipt and storing it that way. You can make notes on the printout, and it will also hold up longer in storage. Receipt paper is really flimsy, and also the ink will wear. So if you are storing hard copies, make a copy first. One thing many of my clients ask is, why do I need to keep receipts if I have the transaction documented on my bank or credit card statement? You really can't rely on bank statements or credit card statements or canceled checks. These are important, yet insufficient without actual receipts. The IRS may see on a credit card statement that you spent $435 at Staples, but they have no idea exactly what you bought. It could be that you purchased movies and technical gadgets, or maybe $400 worth of Swedish fish, and not office supplies you declared as an expense. For record-keeping purposes, bank statements, credit card statements, and canceled checks are excellent, but the detail of the transaction, which the receipt provides, is critical for an IRS auditor. Avoid cash. This is truly important. Cash is hard to track, easy to spend, and nearly impossible to reconcile even with receipts. Use debit and credit cards. They provide you with monthly statements that can be easily matched to your receipts. And there you have it. Receipt basics. General rule, just keep everything. I can't stress this enough. Hello everyone, thanks for tuning in, and welcome to the second episode in my Bookkeeping Basics mini-series. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online, while also sharing insightful videos on all things business ownership and finance. Now, if you haven't watched the intro to this series or episode 1, head over and watch them now. I am releasing these videos daily over the next week, so you can binge and take notes. But order is important, as I might overlap material from video to video. In this episode, I will be covering all the whats, whys, and hows when it comes to outsourcing. Outsourcing is something I get asked a lot about in my DMs on Instagram and emails and even in person by business owners I meet. When do I know it's time to outsource? They ask me, and my answer is always the same. If you're asking, then it's time. Outsourcing is scary for many business owners. They are worried about giving up control. They think they can do it all themselves, or they believe outsourcing is expensive and they might not be able to afford it. These are all very common worries, and maybe you watching this video right now can relate to this. But what is the cost of not outsourcing? And how do you know when you are truly ready to take that leap? Here are some questions to ask yourself. How much time do you spend on bookkeeping each month? And how much time do you have to spare? Does the thought alone of bookkeeping add extra stress to your day? Are you behind on your bookkeeping or unsure of your accuracy? Do you ever feel unsure whether your financial records or tax filings are correct? If you answered yes to any of these questions, that should give you the indication on whether you and your business are ready for a bookkeeper. What to look for. There may be some personal preferences you have when it comes to what you are looking for in a bookkeeper. Or maybe you meet a local bookkeeper at a networking group or was recommended to somebody by a fellow business owner you trust. Regardless of who you choose, here are the basics of what to consider when looking to outsource your bookkeeping needs. Experience. Experience comes in many shapes and sizes. You may think that if you have a small business, the experience you need from a bookkeeper can also be small. There is nothing further from the truth. You need as much experience as you can afford, because great bookkeeping and accounting is instrumental in growing your business and maximizing your profits. Education. Though formal education for bookkeepers is not necessary, it is nice for them to have some sort of proficient training in the matter. Too often do I see disastrous books come from clients who had their spouse, friend, or family member, or even a random office staff member handling their finances. QuickBooks offers certifications in varying levels of accomplishment, so maybe consider that to be a basis for your bookkeeper search. A great bookkeeper is always going to be thinking 10 steps ahead, helping you prevent problems rather than just helping you solve them. The educated bookkeeper is going to want to grow with you and your business. This desire will keep them sharp, focused, and looking ahead to help your business become a financial success. Banking technology. In the 21st century, being able to conduct commerce over the internet is not just a luxury, it's a necessity. Working with your bank and other third-party companies to pay bills and receive payments is crucial to remaining competitive and strong. Being able to access your financial data online from anywhere is now a key aspect of running a business. Make sure your bookkeeper is capable of conducting your business online in a safe and secure manner 24/7. Software and systems. Are you still writing checks to pay vendors, employees, and others? If so, stop it. Stop it right now. But a great 21st century bookkeeper has the ability to conduct a majority of your financial business electronically. We have been able to do individual parts of this for some time. The problem has been that these time-saving techniques have not all been tied together. Fortunately, QuickBooks Online has been able to glue most of this together and created a streamlined, cloud-based program that is efficient, cost-effective, and extremely secure. QuickBooks even works in conjunction with over 20,000 online banking systems, allowing for a smooth flow of data from a single access point. If you're not already set up with QuickBooks Online, make sure that your bookkeeper can assist you with setting up your online profile and transferring in all of your data. Accounting policies and procedures. You already have accounting policies and procedures in place, whether you know it or not, but they are probably not yet where they need to be. Policies and procedures are the guidelines you establish on how bookkeeping and accounting get done in your business. how items get posted, when bills are paid, on what day your employees get their paychecks, when you close your monthly books, and who reviews what and when, and so forth. It is extremely important that no matter what bookkeeping solution you choose, you set up at least simple guidelines. If you are a nonprofit or if you have certain types of government loans, you may have to adhere to policies and procedures specific to your loans, grants, and fundraising. Your bookkeeping solution should be able to guide and direct you in establishing policies and procedures and should be savvy enough to adhere to any guidelines you already have in place. Data entry, reporting, and reconciling. Bookkeeping is not just about entering numbers into the ledger. It is a thoughtful understanding of the business at hand, managing the day-to-day input of information, outflow and inflow of cash, and much, much more. Having accurate financials at your fingertips allows you to react quickly and swiftly to situations that arise. For example, let's say you have a vehicle or a machine that your business depends on, and it unexpectedly breaks down. Or worse, maybe it gets totaled. Unless you have a large pile of cash hidden in a mattress somewhere, you're going to have to borrow money to replace that equipment. You can spend days or weeks trying to catch up with the bookkeeping to satisfy your bank or lending institution, or you can just print out up-to-date financials. But those days or weeks could mean the difference between success and failure of your business. Keeping on top of the data entry, reconciling, and reporting also means you head into tax season armed with every expense, depreciation, and deduction you possibly can file, saving you hundreds, if not thousands, of dollars on your tax bill. Bottom line, your bookkeeping solution should provide you with the reports and regular updates you need to make good decisions every day of the week. Tax preparation and planning. Okay, set the scene with me here. It's January 15th, and you suddenly realize that tax season is here. You call your bookkeeper in a panic, asking him or her to make time to get all of the bookkeeping finished and the reports ready for your tax filer. If you had a great bookkeeping solution, December would have already been closed out and year-end reporting would be at the push of a button away. You would not have to worry about mistakes, missing expenses because you were in a hurry, or risking an audit. A great bookkeeping solution will warn you about red flags that might arise in terms of unforeseen tax burdens. When your business is growing, you may not be taking into account that you will be paying higher taxes and/or heading into a new tax bracket. Your bookkeeping solution should be able to see that far ahead and help you plan wisely so that you are ready to meet growing pains and keep the finances under control. Freelancing is the future. Don't be concerned with hiring a freelance bookkeeper. Freelancing is literally the future. Not many bookkeepers are even willing to work on location these days, and honestly, it's completely unnecessary. If you're looking for even more reasons why you should outsource, freelance bookkeepers often make the business owner money by freeing up time so the business owner can focus on what they love to do and growing their business, saving the business owner in accounting fees and the potential they have to pay less in taxes with accurate financial management. Many bookkeepers, like myself, are progress focused when it comes to the way they approach client work. Not only should a bookkeeper keep your finances in tip-top shape, but they also, like mentioned previously, find ways for you to save and increase profits. After hiring a good bookkeeper, business owners typically see an average of 16% increase in profits within the first year, making the cost of the bookkeeper minuscule. Forbes magazine even mentioned that freelancers are more productive and have a happier outlook on their professional lives than those of employees. Hello everyone, thanks for tuning in and welcome to the third episode in my Bookkeeping Basics mini-series. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online. while also sharing insightful videos on all things business ownership and finance. If you haven't watched the intro or episodes 1 and 2 in this series, head over and watch them now. I am releasing these videos daily over the next week, so you can binge and take notes. But order is important, as I might overlap material from video to video. In this episode, I am covering the what's, whys, and how's of business bank accounts. Hopefully by the end of this video, you will be better prepared to select the best bank account and banking style for your business. I'm sure most of you don't know, but before becoming a mom and the home bookkeeper, a big portion of my financial experience came from corporate banking. Don't worry though, as my opinions in this video are completely unbiased. I will be shooting it to you straight and giving you all the information you need to make the best decision for you in your business. Whether you're just starting out or have been operating for years, having a proper business bank account is essential. Every professional venture or company, no matter how small, needs one. It is the epicenter of your business's financial operations, as it receives deposits from customers and makes payments to your employees and vendors. It can also be important for proper bookkeeping, tax reporting, and for various legal reasons. Number 1, protecting your personal funds. If you use a single account for your personal and business finances, your personal savings could be at risk in a lawsuit. That means if somebody sues your business and the court awards them compensation, your personal money could be fair game, even if the way you earned it had nothing to do with your business at all. A small, separate business bank account protects your personal savings in these types of situations. Number 2, avoid tax issues. Maintaining a separate business bank account makes it easier to track business earnings and expenditures. This can save you a lot of headache when you go to file your taxes, and it can help you avoid problems with the IRS. Separating your personal and business finances indicates to the IRS that you are running a legitimate business and not just a hobby business. Number 3, accepting credit cards. You cannot accept credit or debit card transactions through a personal bank account. If you have customers that habitually pay with cards, you need a business bank account to process them. Otherwise, you must limit your customers to paying with cash or a check, and that could deter some from working or shopping with you. Number 4, give others access to company funds. When you're running a partnership or a corporation, you probably won't be the only person who needs to make a business purchase or access the company funds. You don't want your business associates using your personal bank accounts, so a business bank account for an LLC or corporation is a much better arrangement. And number 5, maintain a professional appearance. Your company will appear more professional if you can write your vendor a check from an LLC bank account rather than from a personal bank account. Customers may also feel more secure writing checks to a business name than to you as an individual. There is no right type of business bank account. What you need varies based on what type of business you have, its size, and its complexity. That being said, certain common account features exist that all business owners, no matter what their field, should consider when shopping for a financial institution. And that's banking rewards. Does this bank offer bonuses, relationship benefits, low fees or requirements? Location and accessibility. Where is this bank located? Are you comfortable doing all finances virtually, or do you prefer a brick and mortar location? Something to ask yourself. Interest rearing. Does this bank offer interest on checking and savings? Do they have low rates for credit cards, business loans, etc.? Online features and services. You cannot escape the world of online banking, so look for a bank that has features you need on a platform that makes it easy for you to use. Other bank offerings. Banks are all about relationships. I remember when I was in banking, I had to wine and dine clients or potential new clients in order to swindle their personal and private accounts, along with their business relationship. Look for a bank where the other products and offerings, aside from your business needs, are a good fit too. The ease of having an established relationship with an institution is convenient for you, but also the banking staff will encourage that regardless, so it's definitely something to consider. Cash deposits. Even though the world is more digital now than it has ever been before, some people still carry cash. So if your business accepts cash payments, you may want to consider an institution that's local or allows services to accommodate cash deposits. Before you can even open a business bank account, you'll need the following established. I go over all of these in more detail in my other series, Business Basics, so make sure you're subscribed to my channel and turn on those bell notifications so you'll be alerted when new videos are available. An employer identification number. Most banks require business customers to provide their employer identification number, or an EIN, in order to open a business checking or savings account. Though some may permit sole proprietors to open a small business account with just their social security number. Personal identification. Just as when you open a personal bank account, your bank will want to see a driver's license or a passport or another form of state-issued photo identification to prove you are who you say you are. Business formation documents. Your bank will need a copy of your formation documents. For a limited liability company or an LLC, this means the articles of organization. For a corporation, it's the articles of incorporation. These documents list some basic information about your company, including its management structure, who is responsible for managing the finances, and how your business will operate. Ownership agreements. If you're running a partnership or a corporation, you and the other owners will need to create a partnership agreement or an operating agreement. This will outline each owner's rights and responsibilities, as well as how the business will operate. Your business license. Your bank needs proof that your business has the appropriate licenses before it will enable you to open a business bank account. The requirements to obtain a business license vary depending on where you live, so do some research to find out what's required in your area. Certificate of assumed name. If the name you use to advertise your business to your customers is different from the company's legal name, you will need a certificate of assumed name, also known as a doing business as, or a DBA. Your bank will need a copy of this as well when you open your account. Monthly credit card revenue. Now, I will always suggest using QuickBooks payments in their merchant services. It ties with your QuickBooks Online profile. They have on-the-go card readers that connect via Bluetooth to any kind of mobile or tablet device. They have full POS systems that can be easily installed at your business if that is what you need. But for businesses interested in opening a merchant services account at their bank to process debit and credit card transactions, they need to provide their bank with the details of their average monthly credit card revenue. Startups may not have any prior credit card revenue, but they should at least have an idea or an estimate of how much they expect to do on a monthly basis. When you're deciding where to open your financial accounts, you may wonder, should I go with a bank or a credit union? Today, there are fewer differences between the two in terms of convenience, especially if the credit union you're considering has good online services and is a member of a co-op that provides access to branches and ATMs nationwide. Both banks and credit unions also offer equal safety for your money via federal government-backed insurance. As you look into banks and credit unions, consider what matters to you most. For example, a slew of ATMs or the lowest fees on a checking account. Banks are owned by investors and operate as a for-profit institution, and banks must make a profit for their investors. Anyone is eligible to open an account with a bank, including individuals or companies. Customers do not have a vote or a say in how a bank is run, unlike a credit union, which has a membership. At a bank, you are a customer. At a credit union, you are a member. Credit unions are not for profit and are owned by their members. And according to the Credit Union National Association, 120 million Americans belong to one. Banks must make a profit for their investors, and credit unions have no need to make a profit for their members. Instead, their goal is to keep their fees low, to set their interest rates on savings as high as possible, and to set their interest rates on loans as low as possible. Credit unions must limit their customer base to what's called a field of membership. This can include a company where people work, a school or a place of worship, a geographic area, or a membership in an organization. National credit unions get creative about how to increase membership eligibility. Connexus, for example, enables membership through its association, which people can join for $5. Members of credit unions also have the ability to vote on credit union policies and participate in decisions. Customers of a bank do not have this ability. Product offerings. Banks offer both personal and commercial banking products, including business credit cards and business loans. Banks may offer investment products and saving vehicles like IRAs, individual retirement accounts, certificates of deposit, and money marketing accounts. Credit unions tend to offer fewer products than banks, especially in the commercial banking arena. Credit unions, which tend to be considerably smaller than banks, also typically offer fewer investment products, limited to checking and savings accounts and the occasional credit card. Interest rates. When you're looking for a loan of any type, it's always best to check both with your local banks and credit unions. Online banks may offer lower rates than brick-and-mortar institutions with an online presence, but banks usually cannot compete with credit unions in this arena. In many cases, you'll find that credit unions offer the lowest interest rates on all loans, such as car loans and mortgages, the whole shebang. As for interest rates on savings products, you'll probably find that credit unions offer higher rates than banks. The National Credit Union Administration, using data from S&P Global Market Intelligence, regularly compares interest rates for savings deposits and loans for banks versus credit unions. Its 2020 third quarter table shows that credit unions posted higher interest rates on CDs and money market and savings accounts and lower interest rates on most home and car loans. Fees. Since banks must make a profit for their investors, they tend to have more and higher fees than credit unions. Free checking accounts at banks usually come with stipulations, such as minimum account balances or requirements for additional account types, like mortgages or credit cards. The fees for errors, such as a bounced check or overdraft, tend to be higher at banks too, especially if you don't qualify for a premium account. Again, when you're researching banking fees, it's important to compare both online banks and brick-and-mortar firms. Many credit unions offer checking accounts with no minimum balance and no monthly service charges. Depending on the credit union, the fees for banking errors, such as a bounced check, may be lower than a bank as well. Online services and technology. Large banks tend to have more money to spend on technology. As a result, they are known for adding technical services much more quickly than credit unions. Mobile banking services are likely to be far more advanced at a bank. If technology and online banking are keys to your choice, make a list of your must-have services and ask for a demonstration of them before opening an account at a bank or a credit union. National and global banking companies often have large budgets for technology, unlike many small credit unions. However, it's possible to find national credit unions with digital banking options that provide most of the services that you need. Make sure to ask credit unions about their mobile banking technology and check their websites for simplicity and services. Some key points. Credit unions tend to have lower fees, but better interest rates on things like savings accounts and loans. While banks' mobile apps and online security technology tend to be much more advanced. Banks often have more branches and ATMs nationwide. Some credit unions do offset this advantage with what's called a co-op and the shared branching network of over 5,000 branches and more than 54,000 surcharge-free ATMs. Credit unions are known for providing better customer service, while large banks tend to be stricter on the rules and have less flexibility in the day-to-day decision-making. A financial cocktail. It's no secret I love a good cocktail or a glass of wine, and my mission here is to make finance fun for y'all. So here are my opinions on the subject of choosing a financial institution. Create a blend that works best for you and your business. Take advantage of the benefits each bring, like having a savings account and credit card at a credit union, and your bigger banking needs at a global or nationwide bank. Building a financial relationship doesn't mean putting all of your eggs in one basket. Shop around, do your research, and figure out your wants and needs, and then go on and make the best choice for you and your business long term. Hello everyone, and thanks for tuning in. Welcome to the 4th episode of my Bookkeeping Basics mini-series. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online, while also sharing insightful videos on all things business ownership and finance. If you haven't watched the intro or episodes 1 through 3 in this series, head over and watch them now. I have linked all the videos in the description box below. I am releasing a video a day over the course of a week, so you can binge and take notes. But order is important, as I might be overlapping material from video to video. In this episode, I am covering the whens, the whys, and the hows of a bookkeeping schedule. Hopefully by the end of this video, you will be prepared to keep your business financials in tip-top shape, knowing when to complete tasks, why each task is important, and how you can manage it all in the beginning before you outsource like we discussed in episode 2. It's important to stick to a bookkeeping schedule for many reasons. Here are the 3 I deem to be most important. So you don't get backed up in case of an audit. So you know where your business stands financially. And so you can track your finances and look for areas where you can increase profitability and also reduce your risk of fraud. To keep on track, it's a general rule of thumb that bookkeeping tasks should be done on a weekly basis or at least monthly basis. Here is my bookkeeping checklist. I have included a free PDF checklist printout in the description box below. You'll want to enter and review all expenses. Record payments and income. File or digitize your receipts. That should be number 1. It's most important. Balance your financial accounts. And send and review all of your invoices. QuickBooks Online makes it easy to manage your expenses, for a little while at least. While your business is new and you are getting things up and running, the month-end tab in QuickBooks Online helps you close out each month you are in business. The online dashboard can help you stay on task with your bookkeeping duties. Like the first in our checklist, entering expenses. Expenses are an easy task for any business owner to lose track of. Outside of this mini-series you are watching right now, I have other tutorials designed to help you navigate the ever-changing QuickBooks Online. When you are finished with this video, feel free to head over and watch my expenses video. I will always be adding more videos and updates on previous videos as QuickBooks Online makes changes, updates, and adjustments following new audit and accounting procedures. Many new business owners get swindled into using third-party processors for their credit card transactions. Of course, this is something I do not recommend. The idea some have, or some are told by the salesman, is that it'll save them money. But in the long run, it's harder to manage and extremely difficult to track the deposits. Ultimately, in the end, it costs business owners more. I highly recommend using all of the QuickBooks Online features that are already paid for within the QuickBooks Online subscription. This allows for seamless accounting, especially for somebody not experienced in the field. Now, if your business often accepts cash or check payments, make sure to record this regularly in the system to keep up with a paper trail. Payments can be recorded on the spot if you are using QBO POS, which is a point of sale system by QuickBooks Online, and a receipt can be generated just like any other POS system. If receiving a check payment, do the same thing, but scan an image or snap a photo on the mobile app just like you would a receipt. I can't stress enough how important it is to manage your receipts properly. I love the Epson receipt scanners and have linked both the office and the portable versions in the description box below. They are always there. They are in the description box of every single one of my videos. And if you're not up to date on the receipts episode, head over and watch it now. It's episode 1. And it's episode 1 for a reason. Reconciling your accounts is a monthly task rather than a weekly task. This is where you match up the data on the bank statement with the data that's in QuickBooks Online. I have a few reconciliation videos on my channel, so feel free to head over and watch those when you are ready. Month-end reviews and reconciling your accounts is extremely important for managing your financial status. This can help you detect duplicate entries in the system, fraud, and generate accurate reports, so you have an understanding of where you are financially. Sending out your invoices. If this is something that doesn't happen automatically as a point of sale, and you are more of a service-based business like I am, sending out your client invoices on a routine schedule is crucial. Alert your clients of when they should expect your invoices. I like to invoice my clients on the 10th and the 25th of the month. For my smaller clients, who I only bill once monthly, I like to invoice them on the 10th. It's a good business practice to outline this billing schedule in your consulting or client contracts. More videos on client contracts, along with my Business Basics series, are available on my channel. For now, if you need a quick tutorial on invoicing in QuickBooks Online, check out my invoice video. And I also have customizable versions of the consulting agreements and credit card authorization forms that I use linked below. Hello everyone, thanks for tuning in and welcome to episode 5 of my Bookkeeping Basics mini-series. I'm Emily, the home bookkeeper, and on this channel I help business owners and fellow freelance bookkeepers navigate the ever-changing QuickBooks Online, while also sharing insightful videos on all things business ownership and finance. Now, if you haven't watched the intro to this series or episodes 1, 2, 3, or 4, head over and watch them now. I have linked all the videos in the description box below. I am releasing these videos daily over the course of a week, so you can binge and take notes. But order is important, as I might overlap material from video to video. In this final video, I am covering everything you need to do and know about prepping your business's financials for tax season. Like, what does prepping for taxes look like? Why tax prep is essential for a smooth filing, and of course, how to get it all done and ready to hand off to your accountant. You can't file your taxes correctly without the right form or forms. So identifying the proper tax documents you'll need is one of the first steps that any small business owner should take. The type of forms you require will depend on the nature of the business you run. If you're a sole proprietor, attach a Schedule C form to your personal income tax return, or use a 1099 miscellaneous. If you're a corporation, use Form 1120. If you're an S Corp status, use Form 1120S. Keep in mind, your tax liability can vary widely based on what type of business entity you have. Your accountant or tax preparer will be able to explain the impact of your business type on your tax burden. Meet with a bookkeeper. If you don't have a bookkeeper yet, this is your sign to get one. Regardless of how small your business may be, hiring a bookkeeper to help you navigate your business's financials from day one is a lot easier than them coming into a mess later down the road. If you are just starting out and can't find a bookkeeper, my firm, EDJ Consulting Group, is a fully inclusive, inviting environment that works to support business owners from the very beginning. Visit edjconsultinggroup.com for more details. A bookkeeper is a valuable resource when it comes to small business tax prep. That's why meeting with a bookkeeper is on the top of my small business tax prep checklist. Many bookkeepers do not prepare tax returns, but an experienced bookkeeper knows many of the answers to your tax preparer's questions before your tax preparer even asks them. Schedule some time to review the previous year's financials with a bookkeeper. Make sure any questions they have for you have been resolved. Ensure all of your accounts are fully reconciled, and make sure to review the balance sheet. Being comfortable with where you are financially before your tax appointment will make the process go a lot smoother for both you and your tax preparer. Also, bookkeepers are a lot more affordable than accountants, so you don't want to rack up all of those billable hours on something a bookkeeper can do for half the price. Update your mileage log. Mileage is key if you are somebody who drives, travels, or bounces around from job to job. If you use your personal vehicle for business, deducting the standard mileage rate on your tax return is usually more beneficial than deducting your actual vehicle expenses for the year. The trick, of course, is you have to track your mileage in order to take the correct deduction. Fortunately, the days of keeping a paper log are behind us, and with the QuickBooks Online mobile app, you can track miles directly from your smartphone. Before scheduling your tax appointment, make sure your mileage log app has been updated and all trips have been properly classified as either business or personal. Print out the report and take it to your tax preparer, along with your vehicle mileage at the beginning and the end of the tax year. Avoid the temptation to estimate your mileage deduction. The IRS requires you to keep a log, and failure to do so can lead to your deduction being disallowed in the event you are ever audited. Gather your financial records. Bookkeepers and those pesky gossip journalists have a similar catchphrase. Show me the receipts. Documentation is everything when it comes to filing with the IRS. The IRS is not your neighbor or your friendly cashier at the local co-op. They do not take your word for anything. They require proof and documentation to legitimate your claims and deductions. Here's a list of some of the most common documents that small business owners should track down before filing. An income statement, the balance sheet, bank and credit card statements, payroll documents, last year's business tax return, partnership agreements, accounting documents, asset purchase details, and depreciation schedules. By making sure all of this information is on hand before beginning, business owners can make the tax preparation process less time-consuming. Ideally, you should be using a business accounting program like QuickBooks Online to generate most of these financial records for you. You'll also want to capture all expenses you paid for out of pocket. Do you purchase things for your business using a personal Amazon account? Have you ever used a family PayPal to subscribe to a business service? As much as possible, you should always separate your personal from your business finances. But even if you do use a personal account for business expenses, those expenses are legitimate tax deductions. That's why scanning your personal expenses for business purchases makes the Home Bookkeeper Tax Prep Checklist. How do you capture these expenses? Review your personal account activity for the previous year and isolate any business expenses you find in them. If you act before the end of the tax year, you can write yourself a reimbursement check from your business bank account and capture the expenses that way. Oftentimes, there are expenses you may not remember until after the beginning of the new year. In that case, enter the expenses into your bookkeeping by creating a journal entry, debiting the appropriate expense account, and crediting an equity account. Record all personal expenses paid for from your business accounts. Just as you may purchase things for your business using your personal accounts, you might occasionally grab your business credit card instead of your personal credit card when you are in a rush at the grocery store. These personal expenses need to be recorded properly in your bookkeeping system so they are not improperly deducted as business expenses. Ideally, you would repay your business for these expenses, but it's much more common to simply enter the transactions as a credit to your checking or credit card account and debit to either a loan to a business or equity account. The best way to avoid this problem in the future years is by using a separate bank account and credit card just for your business expenses. Now it's time to gather any 1099s you have received. Forms known as 1099s serve as tattletale documents to help the IRS ensure taxpayers are reporting all of their income. If your business is service-based, you'll likely receive 1099s from a number of your customers or clients. If you provide any work for a company or individual as a non-employee, you'll receive a 1099 miscellaneous form. Since 2012, credit card processors and payment processing companies like PayPal and Stripe have been required to issue a new kind of 1099 form called 1099-K. Form 1099-K is used to report credit card and debit card payments in excess of $20,000. Form 1099-K is also issued when a payee receives payment for more than 200 credit or debit card transactions in a year, regardless of the annual dollar amount. Most tax preparers don't use Form 1099 miscellaneous or Form 1099-K to prepare businesses' tax returns, but they review them to ensure their clients are reporting at least as much income as the total reported on the 1099s received. That's why this tip makes our small business tax preparation checklist. Make sure you have issued 1099s as appropriate. The IRS requires you to issue Form 1099 to any non-corporate service provider to whom you pay more than $600 in a given year. The corporation rule does not apply to attorneys who must be issued a 1099 regardless of corporation status. There is an exception though. If you pay for these services using a credit or debit card, or if you use a payment service such as PayPal or Stripe, you must exclude those payments from your 1099 reporting. The payment processor is responsible for reporting those payments on Form 1099-K. Other rules apply to 1099 reporting, so also double check with your bookkeeper to ensure you have issued all necessary 1099s. Pull receipts for asset purchases. Assets include furniture, computers, vehicles, and any other large purchases. Generally speaking, an asset will cost at least $500 and is expected to be in use for more than 1 year. Typically, businesses depreciate assets slowly, deducting the full purchase price of the asset over a number of years. However, thanks to a provision of the tax code called Section 179, you can choose to depreciate the cost of certain eligible assets all at once in the year of purchase. Your tax preparer will need to know when the asset was purchased and what was included in the purchase price. So pulling these receipts makes our small business tax preparation checklist. This will help them determine how much depreciation can be recorded in the tax year, or whether the asset qualifies for Section 179. Your tax preparer may also want to retain a copy of the receipt or other purchase documentation in their work papers. Ensure your loan balances match your balance sheet. Many small business owners record the entire amount of their loan payments as a decrease in liability owed. Not only does this cause the loan balance to be reflected inaccurately on the balance sheet, but it also doesn't separate out the interest paid. Loan payments for principal are not tax deductible, but the interest on a loan is. Review your loan statements at the end of the year with your bookkeeper, and make sure the loan balances on the balance sheet match the balances on these statements. As is the case with bank and credit card statements, many tax preparers will want to review your loan statements before preparing your tax return, so include them in the paperwork you take to your tax appointment. Remember to deduct estimated tax payments. Most small business owners make estimated income tax payments throughout the tax year. In addition, business owners must deposit payroll taxes on an ongoing basis. When you finish your tax return, deduct the income taxes you've already paid from your total income tax liability. That way, you won't be overpaying your taxes. Schedule a pre-appointment call with your tax preparer. Few things are worse than showing up to your tax appointment unprepared. Not only does this mean you have to make multiple trips to your accountant's office, but it also delays the preparation of your return. Your accountant knows what information they will need from you in order to file your return. In this video, we have highlighted the information you need for your business tax return, but additional information will be needed for your personal tax return. Many accountants create client organizers to help ensure their clients are fully prepared for their tax appointments. Asking for a client organizer or other guidance from your accountant can prevent many headaches as you prepare for your tax appointment. For more business resources, my online, self-paced home bookkeeper masterclass, business supplies, gadgets, must-haves, and more, make sure to check out edjconsultinggroup.com/resources. Linked below. And of course, like this video, subscribe to my channel, and turn on those bell notifications so you'll never miss an upload. For even more content, feel free to follow me personally on Instagram at Emma Dawn and connect with me on LinkedIn. And if you need more assistance, personalized one-on-one entrepreneurship coaching, or bookkeeping and payroll management, feel free to email or visit edjconsultinggroup.com. My firm is fully inclusive and ready to help you along wherever you may be in your entrepreneurship journey.